the grand majority of business owners are not corporate filers. They are pass-through filers. They're S corporations and limited liability companies, partnerships as well. Out of the 30 million filers of tax returns that are considered to be small businesses, really a small percentage. I think it's like less than 10%. But the trickle-down effect means that if corporations are seeing their tax rates go up from 21 to 28%, I mean by a third, means that they just have less money to spend, simply, right? So if they have less money to spend, that means they will invest less and they will hire less. Big corporations hire landscapers, consultants. If their budgets are constricted because of higher tax rates, all of those small businesses will be constricted as well. So that's the impact of the corporate tax increase.
The following is brought to you by Thryv, the end-to-end client experience platform that helps you get the job, manage the job, and get credit.
Welcome to Winning on Main Street. This is Gordon Henry, and today we're speaking with Gene Marks, head of the Marks Group, about the Biden tax plan and how it impacts small business. Listeners of this show are familiar with Gene. He's regularly featured on Fox News, Fox Business, MSNBC, CNBC. He's also a frequent guest on SiriusXM's Wharton Business Channel and the John Batchelor Show, and he's written 6 books on business management geared towards small business. He's also an expert on CRM software for small business. Welcome, Gene.
Gordon, thanks for having me on. Glad to be here. And it's funny, but this is the second time people have introduced me. I mean, really, all the TV stuff is fine, but I write like on this stuff, for The Guardian, for The Hill, for the Washington Times, for the Philly Inquirer, Forbes and Entrepreneur every week. So that's what really takes up a lot of time. And I'm glad we're going to have this conversation today because I've been writing a lot about all this tax stuff.
Okay, awesome. So what's going on? We're just starting to emerge from COVID, and we have a new administration in for 100 days. And you hear they want to increase the corporate tax, they want to increase the personal income tax, they want to increase the capital gains tax, and they even talk about a wealth tax. What is happening, and how does it impact small business?
Well, I mean, listen, the Biden administration is, President Biden is a pretty savvy politician, Gordon. I mean, whether or not you support him or not, the fact of the matter is that he has a 1-vote majority in the Senate and a very slim majority, like a 6-vote majority in the House. So he entered office really not with a mandate. I mean, half the country, even the races that were won by a lot of the senators on the Democratic side and House members were very, very tight races. But I think President Biden has waited all of his life to put forward proposals that will put him in the history books among FDR and LBJ as people that are making a big impact on our social good for the country. And even though he's got that 1-vote majority in the Senate for budget items, he's going for it. And he's saying, listen, I want to get this through because that's what he thinks is best. So what he thinks is best is a lot of spending. And people are freaking out at the level of the spending that he is proposing. Is it's around $5 trillion when you build in the stimulus money, and then of course his first infrastructure plan, which is about $2 trillion, and now he's got plan number 2, which is more for social infrastructure, which is like another close to $2 trillion. So a lot of business people are really concerned about how that's going to be paid for, and partially it'll be paid for by taxes. But the rest of his spending is really sort of deficit spending. And the idea there is that we can afford to have a large national debt. Our national debt right now, Gordon, is about 1.4 times the size of our economy or GDP, and which is the largest it's ever been. I mean, not even considering World War II. And it is so people are definitely concerned about that. And because of that, right now, Treasury Secretary Yellen has been talking a lot about how that, can we afford this? And she's like, interest rates are at a historic low, and so we can maintain this debt. The issue is if interest rates go up, and interest rates will go up if inflation goes up, and inflation is driven by expectations. And if people see there's a lot of labor disruption out there, there's a lot of supply chain issues, there's a lot of money circulating around. A lot of economists think inflation is going to go up, which means that the Fed ultimately is going to have to increase interest rates, which is going to be put pressure on the national debt, which means we're going to have bills to pay. And all of this comes back to taxes. Like, how is that going to be paid for? That's where it comes back to. So partially he's proposing certain tax increases. And yes, they will impact small businesses directly and indirectly. So let's talk about them. What do you think? Right?
Yeah, yeah. So
Uh,
let's break it down. Why don't we go one by one? So
yep.
first, let's talk about the corporate tax. When
Yep.
you talk about people hear corporate tax, they think big companies.
Yep.
Corporate taxes also impact small businesses, right?
It does. So this will impact small businesses in two ways. The proposal that President Biden is making is, to increase the corporate rate of tax from 21% to 28%. Don't forget, it was as high as 35% under the Obama administration. And then, the 2017 Tax Reform Act reduced it to 21%. So he wants to increase the rate to 28%. He wants to have a minimum tax on corporations because we all read the media about
Mhm.
the Amazons and those companies of the world that pay no taxes. But by the way, that's also a myth because all these companies that paid no taxes, they paid a lot of money in state taxes, local taxes, real estate taxes, payroll tax. I mean, they're paying a lot of taxes, but no income tax. So, Biden wants to have that. And also, they're also pushing for like a worldwide minimum tax to make
Mhm.
things more, competitive among countries. So, how does this impact business owners? The grand majority of business owners are not corporate filers. They are
Mhm.
pass-through filers. They're S
Mhm.
corporations and limited liability companies, partnerships as well. So just that is, I mean, out of the 30 million filers of tax returns that are considered to be small businesses, it's really a small percentage. I think it's like less than 10% are corporate filers. So it will impact those businesses for sure. So it's not a small number. It's just not the majority. The other way that it will impact small businesses potentially is just that trickle down effect, and people will debate the power of the trickle down. Some people think it's complete nonsense. There is no trickle down, whatever. But the trickle down effect means that if corporations are seeing their tax rates go up from 21 to 28%, I mean by a third, that means that they just have less money to spend, simply, right? So if they have less money to spend, that means they will invest less and they will hire less and they will
Higher
pay
less.
benefits. And the fact of the matter is that small businesses like mine, Gordon, I mean, I have some big corporate clients that we sell CRM systems to and provide
Mhm.
services for, and they come with their set of issues. But big corporations hire landscapers, consultants,
Hmm.
marketing people, outside firms, people that clean their offices. If their budgets are constricted because of higher tax rates, all of those small businesses will be constricted as well. So that's the impact from the corporate tax increase.
For the small businesses, I think you said 10% pay the corporate tax. So for the vast majority, they're paying that. You said they're pass-throughs or
Yes,
so they're paying taxes really as a personal income tax, right?
they are. They are. And Biden's proposals will impact them as well. So let's talk about that. So
Hmm.
the vast majority, I mean, more than 90% of the small businesses in this country are these pass-through entities. So what that means is, Gordon, you file you have a partnership return or an S corporation return. You made $1,000 this year. You don't pay tax at the corporate level. That $1,000 comes down to your personal 1040 return, and you pay the tax down there at ordinary rates. Okay. So they wouldn't be affected by that corporate increase. I'll tell you where they will be affected, though. In his speech earlier this week, I don't know when this is airing, but it was like, last week of April, to the joint session of Congress, President Biden saying in his second round of infrastructure, he wants to limit the qualified business income tax deduction, which is the pass-through tax deduction, which came through in the 2017 Tax Reform Act. And that deduction means that if you are a pass-through business, you made $1,000 this year, $800 of it, 80% of that comes down to your personal return. You get a 20% deduction, which is like
Mhm.
right? That's like a big benefit.
Yeah, yeah.
He wants to start limiting that for people that earn more than $1 million a year. Okay.
Mhm.
So for those high earners that have, lots of pass-through income, they would be limited to there. And we're
Mhm.
going to talk a lot about high earners, and
Mhm.
and we can revisit that. But there's this myth about business owners. There's the average business owner makes about 70 grand a year. I mean, and you
Right.
and I know them. They're coffee shop owners and
Yeah.
retailers. And that.
Yeah.
But I got to tell you, man, like I've got like a lot of clients that are manufacturers, distributors, family-owned businesses. I have a lot of clients that have more than one shareholder, three or
Hmm.
four family members. And let's not forget that, they might take out of the business a couple hundred grand a year each to, as their compensation. But some of these companies make a couple million bucks a year. I mean, it's not uncommon for them to have sales of 20 million, $30 million a year. Good for them. So if they're making those, the net profits of the industry is that way, it gets divided among the partners, and that shows up on their tax returns too, even though the partners are only really taking a salary of like 200 grand, because the rest of that money goes back into the business to buy
Hmm.
inventory and fund operations, but it's still part of their taxable income. So these people are, they could be over that $1 million number, even though they're not even seeing the dollars. You know what I'm
Right.
saying?
Yes.
And so it impacts those business owners as well, that qualified business, the reduction of that
You,
credit.
you could be paying more in tax than you actually normally would take home.
Yeah, and that happens all the time. I mean, the biggest complaint I hear from my clients is that, like, hey, Gene, I don't get this, man. Like, you just told me that I owe these taxes because I have taxable income of this. I don't even have any money. Where's my money? Like, I'm
Right.
just,
Right.
and it's because, like, whatever money you're making in your business, you're taking that money and you're buying more inventory and you're sending out invoices and you know what I mean? So
Right.
it
I
like
do.
comes back and forth. So it's just what gets missed by that is that, we have this $1 million earner. And I know a lot of people will be like, oh, boo hoo on those people.
Hmm.
But listen, these guys, these people they're the ones taking the risks. And they're the ones that are, and it's not like they're getting a check for $1 million every year and buying yachts with it. You know what I mean? They're taking a much smaller percentage, and then the rest has to stay in the business, but they're being taxed on that $1 million a year. And now those taxes are going to be even higher.
Right. Which is going to discourage what? Expansion and
Yep.
potentially even formation of small
Yep.
businesses. If you're calculating this before you go into business, this is going to pull you away from the idea of let's start, right? Of
It,
let's
it
get started.
absolutely does. And then the other thing that just impacts this, and it's not necessarily tax related. Business and markets are psychological, and the sentiment right now in Washington is anti-business.
Yeah.
It's pro
Yeah.
worker, not pro business.
Yeah. Yeah.
And the big corporations are going after them, and the
Yep.
high earners and the whatever. It's more of that kind of a sentiment. Whereas under the Trump administration, it was like rah rah rah, to heck with the workers, we love business.
Hmm.
So how it flips. So as a business owner, you're not only have less money to spend because tax rates are going up, but you're less, you have less appetite to invest and take risks when
Right.
you're in an environment right now where you're not sure where the next regulation or tax is going to come from. And I
Yeah.
think that will really impact growth.
Yeah. And then you have the capital gains tax,
Yeah.
and people tend to think of that as Wall Street,
Right.
but it impacts small business owners in a fundamental way. I was talking to a small business owner the other day. It's a real guy who has a sort of contracting type business, and he is very successful. And he's thinking about, when do I sell this business? And with this proposed increase in the capital gains tax, he's like, well, I'm going to wait 4 years now at least and see if the winds, change, if the tides change.
Yeah, he hit it. You're absolutely right. I mean, the narrative is that, oh, the capital gains tax is hitting the big fat cats on Wall Street.
Hmm.
Not the case. There has been a spike in sales of small businesses of late, and and this tax could have a big dampening impact on that, and that's a shame. The baby boomers in this country are within the next 10 years are going to be like 20% of the population. Many of them are sick and tired of it. They want out. And they've been looking to sell. And interest rates are low, so financing is good. Inflation is low, so unless you want to dabble in the stock market, there's not a lot of appetite to put your money. You want to buy your own business. And the millennial generation has gotten older, so there's been a huge growth in startups. And a lot of the millennial, when I talk to people of that age or early 30s, I'm like, yo, don't start up a business. Why are you recreating the wheel? Buy an existing business. I mean, then
Hmm.
you can
Hmm.
make it your own. So there's been this big appetite for this. And capital gains taxes have been relatively low at about 20%. Now,
Hmm.
President Biden wants to increase that to about 28%. And then there's another 3% tax from the Obamacare health plans that gets added onto
Hmm.
that. And then, some states like California and New York have really high, have high capital gains tax rates. And if you're making more than $1 million a year, and again, that gets back to what I said earlier, it's not that unusual for these guys to show taxable income
Mm,
of $1 million, you're going to be taxed at your ordinary rate, which could be as high as almost 40%.
yeah.
39.
Yeah.
So the capital gains tax has gone up a lot. And if you're being taxed at 39.6%, and then you're taxed again at state rates, some states, the Wall Street Journal did a whole analysis recently saying the capital gains tax could be as high as almost 50%.
Yeah.
So think about that, man. Like, you've worked your whole life for your business, and now it's time to sell and retire and kick back with your grandkids. And now you're like, wow, half of my gain is going to go to the government. And what your friend said was right. You're probably just like, they're going to sit on us. We got to come up with another answer here.
Right. Right. So you got that issue. And then there's this talk of this wealth tax, which I don't know how real that is. People
It's
say
not.
it's not unconstitutional,
Right.
but
Right.
this would be the idea that if you have what somebody decides is more, too much money or puts you in a certain category, we're going to take a couple of percent of it away, even though you've already paid taxes on it.
Right, that's correct. So it's accumulated wealth. Different proposals have been out there. That's like an Elizabeth Warren
Yeah.
type of thing. It's for people that have millions that are put away, 5 million and above, and then it starts at 2 million, then 5 million. There is a big argument as to whether it's constitutional or not, because the Constitution only says you tax on income. So and the appetite for that seems, I cannot imagine that actually moving forward about that. And it would just be, you imagine if you're like super rich and you have $1 billion in the bank, okay, but then it's like just every year you have to like give 2% of it away, 2% of it away, 2% of it away, and that's just I don't care how much money you have. That's very rich would be, I can't imagine how long they would stick around in this country if they just have to like get rid of their assets that way.
Right.
So I don't think that's going to be something that's.
Does that impact the small business owner in terms of the value of the asset? If I'm a small business owner and I own a business, let's say I'm 100% owner of a business that's sort of valued at $10 million.
Sure.
And as you said, maybe I'm putting in my pocket 70 grand or 100 grand.
Sure.
If they were to impose a 2 or 3% on that wealth, couldn't you owe more in taxes on the asset than you take home? Yeah.
No doubt. I mean, listen, when you're a business owner, I can have shares right now in Microsoft or American Airlines, which, by the way, I did buy American Airlines right at the beginning of the pandemic. Thank you very much. But then the same thing, you can also have shares in your own company, and
Yeah.
You're right, that's your wealth. And then when it grows to a certain level, it could be subject to that wealth tax. So that could also, be,
So backing up the camera, there
Yep.
seems to be a lot of kind of unpleasant news here for small business owners. What is going to be the outcome of this in your view over the next year in terms of small business success, formation, so forth?
I think for the grand majority of business owners, they're not going to be affected as much. I really don't. I think that I know Robert Reich, the former Secretary of Labor under Clinton, was saying that like 2% of Americans would be affected by these tax increases. And like I said earlier, and I don't agree with that, because there's a lot of indirect effects that we talked about earlier. But as far as your tax rates going up, unless you make, if you're making as a household more than $400,000 a year, that's when you're going to start paying higher taxes. We didn't mention individual taxes, but that's like the threshold. And what President Biden wants is that if you're making in your household more than $400,000, your tax rate would be the highest rate, 39.6%. And therefore, your rates would significantly go up. Remember, if you have a small business, it passes through, it's on your 1040 return, you get taxed at that level. So that would have a big impact. There are some other impacts that people don't like, that he's discussed when he was campaigning. And remember, a lot of this stuff, none of this is like written, that he's talking about what they're discussing, but like we haven't really seen the legislation yet. He was really big on a donut hole tax, Gordon, and I don't know if you're familiar with that or not, but right now, the FICA tax, right, is you owe that up to like 137,000 or something, and then it maxes out at that. You don't have to pay that anymore. It's a 6.2% tax, and then it has to be matched by the employer. What President Biden wants to do is there would be a hole between 137,000 and 400,000, and then starting at 400,000, the tax comes back again, which means that the people earning over that now owe another 6.2% on their earnings over 400,000, And oh, by the way, employers may have to make an employer match for that amount as well. That has a big impact on a lot of small businesses. So that's another thing. There's another thing that doesn't get brought into the tax conversation, but it's part of the tax conversation, and it's payroll taxes. There's been a lot of talk, and I don't know if on your show if you guys been talking about the PRO Act. That's been so it. This is a big issue for small businesses, Gordon. It's the PRO Act passed the House a few weeks ago. It did not have enough votes to pass the Senate, but it is part of the president's infrastructure proposals. And just today, Secretary of Labor Walsh said that he's a big supporter of this PRO Act and really wants to see it happen. It does two things. Number one is it makes it a lot easier to unionize in a company. So people can form unions, they can talk about it during the workday and all that. The big thing is, though, is it reclassifies independent contractors. This PRO Act is the same act that passed in California.
Yeah.
So if you're a small business and you've got independent, like me, I have about a dozen independent contractors that I use to do like development work for me. We have a project and I need some work done in SQL Server or whatever. I hire a guy for 50 hours to do it and whatever. And then I bill him out. I pay him $50 an hour and I bill him out for $100 an hour. Well, guess what? Under the PRO Act, he would have to be classified as an employee for that period of time. And because I have to classify him as an employee, I have to pay payroll taxes for him. Right. And depending on how many hours somebody puts in a year, he might have to be eligible for some of my benefits. Like I might owe him a 401k match on top of all of this. That's a tax. These are all additional taxes, and another big issue for a lot of small businesses that they have to keep in mind.
And needless to say, I guess the famous example now is Uber. So Uber has all those contractors out there who are drivers. They all become employees.
Yeah, you hit it right on the head. That's the famous example is Uber and Lyft. In California, they had a special vote for it, which exempted them. But it is like it's the Uber bill. The answer is yes. If that passed nationally, now all of a sudden Uber would be faced with making all of their contractors employees. And let's not forget, listen, I have 10 or 12 contractors who worked for me for years. They have no desire to be my employee. Okay. I mean, no desire to work for me. They like their freedom. They like their independence. They do their work. They invoice me. They disappear for 3 months to God knows where, and then they reappear and whatever. There are millions of freelancers in this country that there are many Uber drivers that enjoy their freedom, that they have to be tied to Uber as an employee. This PRO Act would take that freedom away from the contractors, the independent contractors. Right. So there's a lot of people, a lot of freelancers that are fighting this too. Believe it or not.
Interesting. So Gene, we're going to just take a quick break, and we'll be back with more on this fascinating issue of taxes.
Are you a small business owner paying too much in tax? My name is Mike Jezoshek, and I'm a CPA and host of the Small Business Tax Savings Podcast. What I want to introduce to you is our tax minimization program. All too often, we see small business owners, when they think of tax, think preparing and filing tax returns instead of tax planning. That is why we launched the tax minimization program. The goal of our program is to make sure that small business owners are paying the least amount in taxes as legally possible. As part of our program, you'll have access to a library of tax strategies along with implementation guides. So not only do you get to understand a tax strategy, but you'll have the guide on how to implement it in your business today. You also have unlimited access to our team to ask general tax questions. Have a tax strategy you want to run past us, or a tax situation that came up, feel free to reach out to our team. We also do monthly group training sessions and have a private Facebook group and so much more. To join our tax minimization program, go to taxsavingspodcast.com/tax. That's taxsavingspodcast.com/tax, and be on your way to saving the most taxes as legally possible.
This episode of Winning on Main Street is brought to you by Thryv, the end-to-end client experience platform that includes everything small business owners need to meet their customers' expectations. Thryv's award-winning and fully mobile interface delivers technology previously reserved for big business to the fingertips of small business owners nationwide. Thryv's built specifically for small business, but there's nothing small about what it can do. Thryv handles your entire customer experience, helping business owners reach more customers, stay organized, get paid faster, and generate online reviews, all from a single device or screen. To learn more about Thryv, visit winningonmainstreet.com and click on Get a Demo. When it comes to software to run your business, there's no comparison. Check out Thryv today.
So we're back with Gene Marks having a discussion about taxes and how they impact small business. And we want to talk now about strategies. How should you as a small business person react to all this news we've been talking about, and what are the best strategies and tactics to put in place to position yourself successfully for the years that are coming? Let's turn it over to you, Gene. What do you think?
Yeah, I've got a bunch of them, Gordon. So please interrupt me if I'm just yakking too much.
No, go ahead.
And by the way, great idea choosing taxes as your topic. We've lost half the audience since we first started, right? But listen, I mean, this is what, 25% for a lot of people, even 30% of their income. It's our biggest expense of the year is taxes. So my smartest clients, they pay as close attention to it as they do their labor costs and their materials costs. There are a bunch of one-time tax incentives this year that expire at the end of this year that, Gordon, we are never going to see again. And these are not only credits against your taxes, but it's money back from the government because they're all stimulus related. So I just want to make sure, as a tax strategy in 2021, you are absolutely talking to your accountants about these stimulus tax programs. And let me sum up what they are. The first is the employee retention tax credit. I'm sure, Gordon, you've talked about this before and heard about it, but I got to bore your audience one more time just to make sure that they're completely clear on what this is. It goes through the rest of the year. So listen, guys, if in 2021 or 2020, any quarter, you were partially shut down or fully shut down, you're an HVAC contractor, you're a restaurant, you're a landscaper, you're shut for any quarter, okay, you're eligible. If in 2021, any quarter, your revenues were 20% less than the same quarter in 2019, you're eligible. If in 2020, any quarter, your revenues were 50% less than the same quarter in 2019, you're eligible. Okay, so partially or fully shut down, revenue loss of 20% or 50%, depending on 2021, 2020. So a lot of businesses are eligible for this. Okay, the tax credit is up to $7,000 per employee per quarter. It's 70% of their wages up to $10,000. Okay, so it's $7,000. You don't have to fill out any paperwork. You get your quarterly 941 return. That's where you do the calculation, and that's where you submit where the tax credit is. Okay, if your credit is bigger than the payroll taxes you owe on your 941, you get the money back from the government. They give you cash. So it's giant. It's like a potential huge credit. It goes through the rest of this year. A lot of people still impacted by COVID, and their revenues are still down. The major payroll services like Paychex, for example, they have it built into their systems. Like if you're using it, Paychex, ADP, anyone, they're all ahead of you. Got to talk to them. You got to talk to your accountant about it because it's an absolutely enormous credit that goes away after this year. So that's the first. Okay. Second, and I'm in a lot of words here, Families First Coronavirus Response Act credit. This year, if your employees need to take a day off to get a vaccine, give them the day off, pay them for it. If they have a reaction to the vaccine, if your employees and they need to take another day off, let them have it. Be a good employer, but you'll get reimbursed by the government for doing it. So again, on your 941 return, if you give people time off this year voluntarily because they were affected by COVID, vaccination related, or even if they have to take time off because their kid's still learning from home, or maybe their family member, got affected. If they have to take that, let them take the time off, pay them. You can apply for a tax credit to get reimbursed for their compensation. So that's the second huge credit, goes through the end of the year. Okay. The third has to do with COBRA. That's your health insurance that people get when you've laid them off. If you laid people off and they're not part of your health insurance, they can still pay for their health insurance under your plan I forget how long it lasts, like 6 months or 12 months. There's a
I
period.
always thought it was 18.
Maybe it's 18 months. I
Yeah.
think you're right. I think you're right. I think it's 18 months. Well, here's what you do. Tell those employees, we got you covered. You pay the health insurance.
Mm.
You can also apply to get that come back to you as a tax credit as well. That way, not only are you being a nice person, you're helping them out, but also you're keeping them close to your company because we have a huge labor shortage in this country.
Right.
So once that's over, hopefully they'll come back and work for you because you're such a good person. So the COBRA tax credit, those three are really, really big. The fourth one has to do with net operating loss carrybacks, which means this. If you lost money in 2020, in 2019, or 2018, you can only do this year. If you lost money in any one of those 3 years, you are allowed one time to carry those losses back 5 years. And if you made money in any of those prior years and you paid taxes in any of those prior years, you can get the money back in cash in your pocket. It's called the net operating loss carryback. So talk to your accountant about that. So just to sum up those four, because I've got one more related to stimulus, the Employee Retention Tax Credit, the Families First Coronavirus Response Act Tax Credit, and the COBRA Tax Credit, and the net operating loss carryback deduction that you get. Okay? One more to bore you with, but this is big. Our biggest issue this year is finding people. People in the construction industry, restaurant industry, retail, across already. I get it. The unemployment benefits, they go through September. It's an extra $300 a week on top of the state. It's keeping a lot of people from going back to work, frankly. A lot of people are not going back to work because they're concerned about their health and safety. But we need those workers to come back. And to get those workers to come back, the fact of the matter is you're going to have to pay them more. You are. You're going to have to bribe your workers to come back. So here's how you can get paid to pay them more. They extended, as part of the Stimulus Act, the Work Opportunity Tax Credit. It is a credit up to $9,600 that you can take. Refundable. You get the money back on your taxes. I have some clients that they've got their accountants connected in by bat phone. And when they've got an employee or a prospective employee that they want to hire, they're saying like, oh yeah, we want to hire you. Hold on for a minute. They're calling their accountants and they're saying, listen, I want to hire this person. What kind of a tax credit, a work opportunity tax credit will I get? The accountant does the numbers, says, Gordon, you'll get a $2,000 tax credit for this employee on next year's tax returns. Great. Thank you very much. Okay, prospective employee, we'll give you $1,000 signing bonus. You come on and work with us because you're still ahead $1,000. So I have clients doing this right now. And, that's a big enticement for employees to come back to work as you do that. And the government will pay you to do just that. That is the work opportunity. So those are all credits related to stimulus. Other than the work opportunity tax credit, which goes on for another 3 years, the rest of the credits expire this year. Talk to your accountant or your payroll service company now to take advantage. And I have some other advice as well, but I'll turn it back to you.
So those are 5 really good ideas, but those all expire this year. So
yes. Except for the work opportunity tax credit.
Okay, because the tax increases we were talking about at the beginning of the show, if they are passed, obviously go forward into the next few years, and the rest of these credits go away, with the exception of the one you just mentioned. So, I guess summing it up, somebody said that only a few percent of small business owners would be negatively impacted by all these tax increases. Do you buy that? Do you think it's only a couple of percent who are really impacted?
I don't. I mean, I think so. You know what I've learned from the pandemic. There was Robert Reich that said that, and so here's what I've learned from the pandemic, Gordon, and also from running a business for 25 years, and also from the last big recession in 2009. No one has a clue. That's what I've learned. They don't know. All I know is what I see out there, and here's what I see. I see an environment where taxes are going up, and regulations are going up, and there's administration in place that's more pro worker than pro business. So I talk to my clients, and they're grumbling and they're not happy about it, and because of that, they don't have an appetite to take risk and invest and hire and all that. And that's what I see. And I also know that when companies have less money because they've spent it, whatever it is, but if it's on taxes, whatever, they have less money. They spend less on employees and
Right.
hiring.
Right.
It's just a fact. So I can't. You say the 2% because I think Secretary Reich goes through all the the people that are earning more than 400,000 a year or $1 million a year, but I think there's a lot of other factors
Yeah.
that skew that number much higher.
Yeah. Yeah. I would agree. Well, Gene, this has been a fascinating conversation. We're just about out of time, but I just want to finish with a bigger picture question for you. All this spending that however we either are able to get the money or maybe we're not, and the debt just goes up. What is the long-term impact? It's got to increase the debt, which, as you say, may have an impact on inflation and then eventually a faith in our currency. I mean, is this good for America?
It depends on who you're talking to. It really does. There has been this growing love affair with a theory called the modern monetary theory, which has been around for a little bit and it's been growing in use. And the theory behind it is, and there's a lot of well-known economists that back it, that basically says that, as long as an economy can absorb the money and it's your currency, you can pretty much spend as much as you want. So in other words, if we want to spend trillions of dollars on infrastructure and whatever, and the money goes out in dollars, not euros, and companies accept the money, turn it around and build roads and hire people and spend that money, you can keep doing that and doing that. That's what it is. Then you talk about the other side of people that are more traditional and they see higher debt. That is okay for now, but it's about debt maintenance. And if interest rates go up, it's going to be really, really tough to maintain that debt. It gets back to what I said earlier, Gordon, because I've been listening to a bunch of economists about this, really smart people. And it is amazing to me how many people they're just arguing and debating just this. They don't know. They're playing with trillions of dollars and they just don't know. And listen, maybe they're right. Who knows? Maybe you can put trillions into the economy and it's all good. And what do we know? What is modern economies have been around for how long? A couple of 100 years? I mean, where we have central banks and digital currencies and all that. I mean, we're babies at this. And maybe we've been doing it all wrong. What can I tell you?
Well,
not my common sense tells me that, but
it's a big bet, but we'll find out. Anyway, it's great having you on. Thanks for the insights. You have obviously thought a lot about this, and we'll all learn together, right, over the next few months.
Absolutely right. It's great talking with you, and have you back.
Okay. Well, thanks for joining us. And if you enjoyed today's podcast, give us a 5-star review and tell a friend or colleague to subscribe. Until next time, make it a great week.